Hello, Super Savers. So it's not looking like the annualized November I-Bond rate will be 12.4% as I predicted in July. I told my husband we should have gotten the more expensive crystal ball for that video. Joking aside, in today's video, I'm going to give the long anticipated update on our November I-Bond rate prediction now that we have 5 of the 6 months of inflation data that we need to determine this, instead of the 3 from the previous prediction video. Plus, I'll answer the question, am I going to stop buying I-Bonds, knowing what I know now? Or should I buy even more I-Bonds? And why? Grab your popcorn and let's get started. For those of you who are a bit newer to I-Bonds, be sure to check out this must-know I-Bond basics checklist that I've included at the very end of this video if you do conclude that I-Bonds are a good fit for your portfolio after this is over. So as a quick reminder, the annualized I-Bond rate that will be announced this November is based on the change in the semi-annual inflation rate, times 2. And this change in the semi-annual inflation rate is calculated as the percentage change in CPI-U between the 6-month period of March 2022 and September 2022. Again, multiplied by 2 to get to the annualized November I-Bond rate. As in our original prediction video, I have assumed a 0% I-Bond fixed rate for November. So those of you who have older I-Bonds with non-zero fixed rates, please do adjust your own numbers accordingly. Now, the September 2022 CPI-U number will only be reported on October 13th, 2022. But this time around, as I mentioned earlier, for this update video, we have 5 months of CPI-U data to work with: April, May, June, July, and August 2022, instead of just 3 months like we had originally. So here are the actual CPI-U numbers for these 5 months from the U.S. Bureau of Labor Statistics website. And for those of you who want to explore things further yourself, here's the link to their website. And here is the monthly CPI-U change with the largest monthly changes happening in March 2022 and June 2022, mainly due to massive surges in oil prices. And this lack of change in the months of July and August, the slightly declining CPI-U, that's also primarily driven by energy costs, but this time going in the opposite direction, downwards. More on that later and what this may mean for inflation and I-Bond rates going forward. Now, if I use the same methodology as in the last prediction video, if I take the average monthly CPI-U change between the end of March and the end of August, that's 0.6%, and extrapolate it out to September, this is what the projected September CPI-U, the September inflation number, looks like. Plug this projected CPI-U number for September 2022 and the actual CPI-U number for March 2022 into this calculation from earlier in the video, and we arrive at a projected semi-annual inflation rate of 3.6%. Take the projected semi-annual inflation rate of 3.6%, multiply it by 2, and there you have it, I-Bond fans, our updated November I-Bond rate prediction of 7.3%, based on the extrapolation method and with a bit of rounding. Well, here's what it would look like. On the left-hand side, we have the actual CPI-U numbers from the Bureau of Labor Statistics. On the right-hand side, we have the projected number, the predictions. This column shows projected September CPI-U under different scenarios. And this one shows the projected semi-annual inflation rate under different scenarios. Remember that this projected semi-annual inflation rate is based off of the actual March CPI-U and projected September CPI-U. And this annualized November I-Bond rate prediction based on TreasuryDirect's formula would simply be this column here times 2. As previously, I've assumed a 0% fixed rate. And this column here, this one is for those of you who want to see whether I'll stop buying I-Bonds or not. This middle row here shows the November I-Bond rate prediction of 7.3% that I just walked through. Remember, it assumes that September's inflation number increases by the same 0.6% as the average monthly CPI-U change between the end of March and the end of August. This row here shows what the November I-Bond rate prediction looks like if September CPI-U stays flat over August. And this row here shows what the November I-Bond rate prediction looks like if September CPI-U actually goes down a bit further. And these two rows at the bottom, they show what the November I-Bond rate prediction looks like if CPI-U goes up again, rather than staying flat or declining. So basically, we're looking at a range of, let's just call it 6% to 7.5%, depending on whether September CPI-U stays roughly where it is now or whether it starts trending upwards again. Let's go back to this table here that we just looked at. On this right side, where the projected numbers are, we have this column here, the annualized November I-Bond rate prediction based on TreasuryDirect's formula, which is the semi-annual inflation rate column here times 2. Well, let's look at the true annualized November I-Bond rate prediction here, which is the sum of this projected semi-annual inflation rate for April to September plus the current semi-annual inflation rate of 4.81% for all I-bonds purchased between May and the end of October. 4.81% is the current annualized I-Bond rate of 9.62% divided by 2. So if we take the projected semi-annual inflation rate under the different scenarios plus the actual current semi-annual inflation rate of 4.81%, here's the true annualized November I-Bond rate prediction for all I-bonds purchased before the end of October 2022, from about 7.8% to 8.6%. Yes, it's less than the current annualized I-Bond rate of 9.62%, and certainly less than the 12.4% that was predicted in July when we had much less data. But it's still, from my perspective, by far the best return one can get right now in the market, and in particular for an investment that's for all practical purposes risk-free. So basically what I'm saying is I will most likely buy some more I-bonds soon for a personal portfolio. And in particular, because we feel that inflation will persist for a while longer, like that long-lost relative who doesn't go home way after Thanksgiving dinner has ended. And here's why. It wasn't because CPI-U was down 2 months in a row. That wasn't a massive surprise given that gas prices had fallen for over 3 months straight. What was most concerning was that despite this massive decline in energy costs, CPI-U didn't go down more. And according to the Bureau of Labor Statistics, shelter, food, and medical care indices were the main drivers amongst many for this. The shelter category, basically rent, increased 0.7% month over month and 6.2% year over year. And this rent number will in all likelihood continue to go up as the Fed raises interest rates, forcing some potential home buyers to rent versus buy, and making home ownership and the financing of it generally more expensive to owners and renters alike, thereby pushing up the already hot rental market across the country. Food prices were up 0.8% month over month and an alarming 11.4% year over year. Because we all need shelter and food. My 4-piece chicken McNuggets, which were on the dollar menu before I left for summer vacation, they're now $2.19. That's more than double. And our beloved Costco mini chocolate chip cookies, up 25% from last year. And finally, medical care services. They rose 0.8% month over month and 5.6% year over year. But healthcare inflation has historically lagged behind overall inflation, meaning these numbers will only keep going up in the coming months. Check out this video here if you're interested in how healthcare inflation has played out in prior inflationary periods. Also, while gas prices have gone down since their massive peak in June, according to AAA, oil is and has always been super volatile. Here's a 70-year historical chart of crude oil prices from macrotrends.net. The gray vertical lines represent the periods of recession. And here's a 10-year historical chart. A cold winter, another turn of events in the Ukraine, or even just 1 or 2 hurricanes disrupting drilling in the Gulf of Mexico could push energy prices back up, and quickly. Also, keep in mind that despite the Fed's efforts to raise interest rates, the Fed funds rate still only sits at 2.25% to 2.5%, whereas the year-over-year inflation rate is at 8.3%. Until rates are above inflation, you and I, super savers, we still have a purchasing power problem. So has inflation peaked? Maybe, or even likely, depending on factors such as oil that I just explained. But is it under control and on the way out? In my view, no. Not that I don't want it to be, because listen, generally speaking, lower inflation and hence lower I-bond rates are actually good for our wallets. But 2 months of CPI-U downwards data in light of declining oil prices that fluctuate wildly versus rising food, shelter, and medical care service costs that are sticky, plus the 6% difference between the Fed funds rate and inflation currently, against the backdrop of another round of government spending bills and announcements, that's not enough optimism for me to start celebrating inflation's end. And that, my financial friend, is the full story on why I'm not going to stop buying I-bonds just yet. They are still paying the best rates in the market given their level of risk, which is basically zero. And if inflation has truly peaked, who knows? But if it has, this may be the last time or one of the last times in our lifetime that we'll be seeing I-bond rates at this current level. Having said all this, I will wait for that Fed meeting later this month before I decide how much more we'll be putting towards I-bonds versus T-bills and the like. As I always say though, everyone's financial journey is different. So stay tuned for more, and in the meantime, take a look at this video here if you want to learn more about T-bills and how to buy them. And as promised, for those of you new to I-bonds, here's the must-know I-bond basics checklist that I mentioned earlier in the video, as well as this video up here on how to buy your first I-bond. All right, I-bond fans, as always, I hope you enjoyed this video, and if you did, don't forget that thumbs up, and see you again soon with another money-saving, wealth-building video.